My name is Josh Wild. I'm a 2019 fellow in San Antonio, and today we're talking about Roth IRAs. So, what is a Roth IRA? Well, it's a specific type of investment account where all the gains, once you sell whatever is in the portfolio, all the profits are not taxed. And this is very unique because typically, whenever you own stocks or whatever other type of investments you might be holding, whenever you sell those positions, whenever you realize those gains, you get assessed a capital gains tax. And typically this is 15%. Now, if you're one of the lucky few that make above $434,000 a year, then this capital gains tax is actually increased to 20%. And that may be the case when you're, 60 or 65 years old, or whenever you reach retirement age. That might be the amount you're assessed at. But let's just assume 15%. And that might not sound like a lot, but it does add up over the course of the lifetime of a portfolio because of compounding. So let's take an example where someone is depositing $6,000 a year into their Roth IRA, and this account is earning roughly 8% growth per year. We can take a look at how this is going to look projected in the future. So if you start in the 2019 contribution year, and we go to the first threshold here, which is 2025. That means you'll have spent 6 years investing. And let's say you max out your contribution every year. You're allowed to put in $6,000, up to $6,000. It could be less. And I know not everyone has $6,000 just lying around to invest. So it can be anything below that amount as well. But let's just say you max it out and you do that for 6 consecutive years. In 2025, you will have invested $36,000, right? 6,000 times 6 years. And your portfolio would be projected to be, in this example, a little over $44,000. So your tax savings, if you were to sell everything you own at that particular point in time in your account, you would be saving about $1,200. Big deal, right? You only made overall in profits, right? 44 minus 36. You made about, what is that? $8,000 in profits. And out of those $8,000, you would have had to have paid $1,200 in taxes. And instead, you get to keep the full $8,000. So that's great, right? Whoop-de-doo. But if you look down the line, you can see each incremental period of time. If we go all the way down to when we reach, quote unquote, retirement age around 2060, over the course of those years, 41 years by that point, we will have invested $246,000. Again, this is assuming you're putting in $6,000 a year. But your portfolio by that point will be worth over $1.6 million, right? So the tax savings at that point become huge. Your tax savings are over $200,000 by choosing a Roth over other types of investment accounts. So why is this July 15th deadline important? Well, the main reason is because the government limits how much a person can contribute towards their Roth IRA each year. They recognize how good of a deal this is. They recognize it's essentially a free gift to investors. So people would take advantage of it too much if they allowed it to be this sort of uncapped contribution level. So they only allow you to put up to that amount per year. And this year, because of COVID, the deadline is usually April 15th every year. It falls in line with the tax deadline. But they extended it to July 15th. So if you want your contributions to count towards the 2019 tax year and essentially get started earlier than you otherwise would have, then this is a great opportunity to start. Now, again, I recognize not everyone has the financial capability to do so. So this is my recommendation. If you have funds lying around, if they're just sitting in a bank account, if they're not doing anything anyways, it might as well just be sitting in a Roth IRA, doing nothing. You don't have to invest it right away, but I'd rather have it being sitting in a Roth than sitting in a Wells Fargo savings account that's earning 0.01% interest, basically giving you a penny every month in interest, right? So again, what is this urgency all about? There's 2 reasons. Number one, it has to do with the future value of money. And this has to do with compounding, right? It's an exponential growth pattern. When you invest $6,000 today, that $6,000 will be worth over $130,000 in 40 years. So by not investing today, you're not skipping out on 6K. You're skipping out on potentially 130K, right? Which is a big deal. So that's the first part. The second part is there's actually an income limit as to when you're able to, how long you're able to contribute towards your Roth IRA. So you're only able to make the full contribution level up until when you make $124,000 in salary when you're single, and $196,000 in salary when you are married. So if you start making more than that in income, your allowable contribution amount actually goes down. You're not able to put in the full $6,000 anymore. So you might as well take advantage of it when your income is lower, because you're actually able to be eligible for this type of investment account. I just want to illustrate this in a couple examples. The first of which is, let's say we have a person who waits 10 years to start doing this stuff. And then they start putting in the $6,000 each year. By the time 2060 rolls around, they will have a portfolio value of $740,000, which is great. I mean, that's a respectable amount. But the person B in this example who starts today, rather than waiting 10 years, if they do the same thing and they invest $6,000 every year, their portfolio will be worth almost $1 million more by the time that they reach retirement age. Now, I know we're in VFA, and a lot of us don't subscribe to the quote-unquote traditional retirement. We want to retire earlier than what's normal, and that's fantastic. We can totally do that. This is just a way to supplement, us building businesses or becoming executives or doing whatever we need to do to live happy and fulfilled lives. So the Roth or any other type of retirement account is just meant to supplement that. By the time you reach a certain age, you're able to tap into some of these additional funds. That's an additional cushion for you to have to help plan for your future, right? So I don't want you to miss out on these gains just because you didn't have certain tools or knowledge available to you, and that's why we're leading this discussion. The other example is even more stark, and I'm grateful for Orion, another 2019er who contributed to this presentation. Look at this example. We take three hypothetical people. The first on the left, this guy Andrew, he started investing just $3,000, not the full amount, maybe just $3K. Started when he was 15 years old, right? Invested each year up until he was 19. So $3K each year for 5 years. And then he stopped. He just stopped, and he let the portfolio ride the rest of the way, right? Compare that to Amy, who started when she was 19 years old and kept investing for 8 years until she was 26, and then she stopped, right? Compare that to Joe, who started when he was 27 and contributed every single year until he was 65 years old, right? Guess who has the highest portfolio value? Andrew, even though he only contributed for 5 years. Since he contributed the earliest, his portfolio is worth the most out of all of them, despite him contributing the least. So time is on your side if you let it be. Some other benefits. Some people are concerned with, well, if I put stuff into a retirement account, I'm not going to be able to touch that money. I can't pull it back out. I'm going to get penalized if I do. It's just money that's just tied up, and I can't use. That's not the case with a Roth, because the money has already been taxed. You already paid income tax on it, and now you're investing it in a Roth IRA. The government's not going to penalize you for taking money back out. That's one of the most beautiful things about this. Is if you need it, if life circumstances, I don't recommend it, but if life happens and you need the money, you can take it back out with no penalty. And you can take back out the amount that you've deposited up to that point. So let's say you've been doing this for 10 years and you put in $3K every year for 10 years. You can take out $30,000. You can't take out any of the gains, obviously, because that's not what you put in, but you can take out whatever you've put in. So my recommendation is, while we're young and while we have a income threshold that's income level that's below the threshold, rather, start with a Roth IRA. Start with something where you're able to qualify for contributions toward this type of investment account, and take advantage of the tax savings that it offers. As you start to earn more money, as you start to earn six figures plus, or what have you, you can shift those investments towards a more traditional IRA or a 401k, where you can then use pre-tax dollars, so you can contribute money towards those accounts and have it being essentially hidden from your income. You're lowering your income levels by contributing pre-tax dollars towards these accounts. So by lowering your on-paper income, you're therefore lowering your income tax in those particular years. And so you don't have to pay as much on your tax returns. So it's a great way you can transition from one strategy to the other as you start making more money, and start positioning yourself in a way that's going to save you the most taxes in the long run. So if this all sounds great, well, how do you get started? Well, there's a lot of providers out there. I would recommend a provider that doesn't charge fees for trading, so zero commissions for different types of ETFs or stock trades or whatever you might be buying with your Roth IRA. And then I would also recommend something that's self-directed. I personally don't like robo-advisors or certain so-called financial advisors that may or may not be acting in a fiduciary manner. I don't think that they know what's best for you as much as you know what's best for you. So if you like a particular company, buy a stock in it. If you just want to go with the safest thing, buy an index fund that mirrors the S&P 500 or the Dow Jones, something that just mirrors the stock market. You can do that. And I would actually recommend Ally Invest, just because they have instant bank verification. They're very easy to use, user friendly. It's easy to see all your positions and all your growth. And some other providers might take longer to verify your bank. And if you're trying to meet that deadline of July 15th, they're not going to cut it. Like Fidelity, for example, is not going to cut it. So I would personally recommend Ally, but you can do your own research and sign up accordingly. So Orion provided this slide, and basically he was just talking about what types of investments could you look into after you've funded your Roth IRA account. Let's say you've deposited $3,000 into your Roth IRA account towards the 2019 contribution year. That's one more thing I just want to emphasize. If you do decide to do this before the deadline, please make sure to check 2019 when you're depositing the funds, not 2020. It often defaults to 2020, so just be cognizant of that. You actually have 9 additional months to contribute towards the 2020 deadline. The 2020 deadline isn't until April 15th, 2021. So you have more time for that one. The more pressing one is the 2019 deadline. So please, if you're trying to do this now, make sure you check 2019. And if you do fund your account, these are some different options that you might look into if you're looking to diversify and invest in different asset classes. You can invest in, like I said, index funds that mirror the market, whether that be the S&P 500 or the Russell 2000 indexes. You can purchase ETFs, which basically are stocks that behave like those markets. They mirror the behavior of those markets, so they're very safe because, like in the example of the S&P 500, it's basically you're having a little bit of ownership in 500 different companies. So you have that diversification of risk. It's not like if you buy just Amazon. Like if you deposit $3,200 right now and you can buy a single share of Amazon. And I'm not going to stop you from doing that, but it's probably not the smartest thing to do, just because Amazon can fluctuate very much and maybe doesn't have as much of the protection as, let's say, a Dow Jones or a S&P 500 fund. So I would recommend doing a little bit of research, finding out what's the best for you, and then investing accordingly. So the last slide here is just kind of a prioritization chart. A lot of people just, when they earn a paycheck, of course, the first thing is expenses, right? You got to pay your rent, you got to pay for food, you've got to pay for certain amenities, and that's fine, and that's crucial, right? But here's where the prioritization should go after all of the necessities are paid off, right? First of which should be an emergency fund. So you should have enough saved up to cover 3 to 6 months of expenses, just in case you ever lose your job or, God forbid, anything terrible happens. You need to be able to be financially prepared. So you need to have an emergency fund saved up first and foremost. The second thing you should put your money towards is if your employer offers a match at 401k match, you should contribute up to that limit. So contribute up to your 401k match, maximize your employer's match. That's basically free money that they're giving you, so you might as well make the most of it. The third priority you should put towards is any sort of high interest debt that you might have. So like credit card debt, for example, or maybe student loan debt if it's above the historical stock market yield. If it's above 8%, I would recommend putting your money towards paying off debts first before you invest in a Roth. And so if you've maxed out your employer contribution in your 401k, if you have an emergency fund and you have paid down maybe, let's say, those credit card bills that you've been putting off, then I would say it's time to do a Roth. So not everyone is in the financial position to do a Roth, and that's perfectly fine. But when you do, I want you to be equipped with the knowledge and be prepared on what you can accomplish with it. These numbers are a little outdated. They're from 2014. I will say that the contribution limits have increased, and they continue to increase, which is the good news. You can contribute up to $6,000 in all of your IRA accounts combined, and you can contribute up to $19,500 in all of your 401k accounts. So those numbers should be edited in those blue rectangles here. And then the very last thing that your money should go to, if you've maxed out everything else, is different types of investments. So maybe, let's say, Robinhood, for example. You're getting double taxed when you invest with Robinhood, right? Because you've already paid income tax on it, and then now you're growing through the stock market, and then when you sell your positions in the stock market, you then have to pay capital gains tax on that. So you get double taxed when you invest in just a regular brokerage account. So in order to avoid some of these tax headaches, that's where the IRA and 401k come into play. So that's what Orion and I would personally recommend. Going with accounts that will save you taxes before going towards accounts that you'll end up getting double taxed on. So that's a brief overview of everything we discussed. If you have additional questions, please feel free to contact me. I just want to help people, make the most informed decisions they possibly can. So please feel free to reach out, and until next time.